The morning of January 28th, 2021, when millions of people looked at their phones, they faced the impossible. The buy button was gone. This wasn't a technical glitch. It wasn't an internet outage. This was Wall Street pulling the plug to stop a game they were about to lose. For years, they told us the stock market was fair. They said, the house always wins. But as a group of rebels on Reddit were robbing Wall Street's biggest hedge funds in their own casino, the rules suddenly changed. They called them dumb money. They mocked them. But that dumb money cost the financial giants a staggering $6 billion in just a few weeks. So, how did they do it? And more importantly, how did Wall Street take its revenge? This is the untold story of the GameStop saga. Here we go. This story begins in a store that reminds us of a smell we all know: GameStop. By 2020, when everyone was downloading games digitally, GameStop was like a ghost from the past. The sharks of Wall Street had caught the scent. Massive funds, especially ones like Melvin Capital, were so confident that GameStop was going to go under. It's called short selling. Simply put, they bet billions of dollars on the company failing. But they made a mistake. Their greed overtook their logic. They shorted 140% of the available shares. They created a mathematically impossible situation. If someone bought those shares and refused to sell, the funds would be trapped. And that is exactly when he entered the scene. Keith Gill, better known as Roaring Kitty. He wasn't a financial genius or a billionaire. He was just an ordinary guy, streaming from his basement, looking at charts, and saying, "This company can't be valued this low." Keith's thesis ignited a wildfire on Reddit's famous subreddit, Wall Street Bets. Thousands, then hundreds of thousands of retail investors caught on. The plan was simple: buy the stock and never sell. For them, this was no longer about making money. It was their way of telling Wall Street, enough is enough. By mid-January, all hell broke loose. The price shot up from $20 to $40, then to $100. And with a single tweet from Elon Musk, the rocket ignited. Hedge funds were bleeding out. Millions of dollars were evaporating every second. Panic had seeped into the towers of Wall Street. As fund managers went on television to cry, Redditors were chanting, "Diamond hands. If we don't sell, they have to buy. We set the price. To the moon!" And so, we return to that morning, January 28th. Realizing the game was lost, big money flipped the table. Robinhood and some brokers halted buying, citing liquidity issues as their excuse. Just imagine, you're in a game, and the referee forbids the winning team from scoring. With buying halted, panic selling began. The stock crashed from $480 down to $40 in a matter of days. Thousands of retail investors who bought at the top lost their savings. The system had protected itself. The fallout reached Congress. Lawsuits were filed, but Keith Gill, wearing a suit, sat before the screen and delivered his legendary defense. "I just like the stock." So, who won? Melvin Capital shut down, Wall Street lost billions, and most importantly, they learned they could no longer ignore the crowd they called dumb money. GameStop wasn't just a stock. It was the first major uprising of the digital age. And make no mistake, it won't be the last. For more financial mysteries and market stories, make sure to subscribe and hit the notification bell. See you in the next video.